This is the Chapter 25 test review. And in this chapter, we're talking about two basic kinds of concepts: capital budgeting and managerial decisions. The capital budgeting section will deal with payback period. These are three capital budgeting techniques: payback period, accounting rate of return, and net present value. So what is capital budgeting? Capital budgeting is analyzing long-term investments and deciding which assets to acquire or sell. The outcome is uncertain, large amounts of money are usually involved, and the decision may be difficult or impossible to reverse once you get going, and the investment involves a long-term commitment. Okay, so here's how men multitask. Let's talk about the first one of these techniques, which is called the payback period. Managers prefer investing in projects with shorter payback periods, so shorter is usually better for this method. Payback period of investment is the time expected to recover the initial investment amount, and the cost of the investment is divided by the annual net cash flow. Annual net cash flow, that's how you get payback period. So here's our first question. 1A. Companies considering purchasing a machine for $21,100. The machine will generate an after-tax net income of $2,150 per year. Annual depreciation expense would be $1,650 on this machine. So what is the payback period for the new machine? Notice this said net income, and what I told you before was cash flow. So we got to convert net income into cash flow. And the way you do that is you take in this case, the investment will be divided by the annual net cash flow, like I said, which is the after-tax net income, and you add back depreciation, because it assumes that this income is all cash except for depreciation, which is a non-cash expense. So if you add back depreciation to after-tax income, you get net cash flow. So in this problem, the investment of the machine was $21,100. and you're going to divide that by the sum of the after-tax net income of $2,150 plus the depreciation of $1,650, and that's going to be $21,100 divided by $3,800, which is 5.6 years. Or again, shorter is better. The quicker you get your money back, the better this situation looks. 2A. Companies considering the purchase of a new piece of equipment for $120,400. Predicted annual cash inflows from the investment are $55,000 for year 1, $20,500 for year 2, $27,500 for year 3, $21,500 for year 4, and $25,000 for year 5. The payback period is, that is, when will we get all of our money back? You know, it looks like we're going to spend $120,400, and let's see how we get this back. So there we are at time 0, and now after 1 year we get back $55,000 and we still have $65,400 to go. Year 2 we take another $20,500 and now we've only got $44,900 to get back, because we took $65,400 minus this, which will give us $44,900. After 3 years we got an additional $27,500, which means we only have $17,400 to get back. And in year 4, we get back another $21,500, which now we only, looks like now somewhere in year 4, we now are in the positive here. We've gotten back more than we spent, to the tune of $4,100. So to find out exactly what that would be, we would do this. We would say after 3 full years we got back, we were only $17,400 away from our goal, and in somewhere in year 4 there, the beginning of year 4, we got back $21,500. So if you take $17,400 and divide it by $21,500 and turn that into a portion of a year, you got 3 full years. You know, 1, 2, 3 right there, and then you've got 8.8% or 0.8 out of 100, 8/10 of a year that you got back, assuming these cash flows are evenly, that you got back the rest of your money. So it wasn't, 4 full years you got back all your money plus $4,100, but it's 3.81 years to go back to zero. That is to get the $120,400 back. 3A. Companies considering the purchase of a new machine for $67,000. Management predicts that the machine can produce sales of $20,000 each year for the next 10 years. Expenses are expected to include direct materials, direct labor, and factory overhead totaling $9,900 per year, plus depreciation of $5,900. The company's tax rate is 40%. What's the payback period? Well, we got to turn all of this into cash flow, and then take the cash flow and divide it into the $67,000. So let's do that. So determine net income from the machine. It'll be the sales minus expenses minus depreciation to give you income before taxes of $4,200. Like I said, we got to turn all this into some kind of a cash flow instead of income. So we've got income taxes also. We got to subtract off that of $1,680, and we'll end up with a net income of $2,520. Now, to turn that net income back into a cash flow number, we've got to add back, take the net income and add back the depreciation, back up here at $5,900. And so this means that the cash flow in this situation would be $8,420, which we can now use to divide it into the cost of the machine to see what the payback period is. And that would be $8,420 divided into 67,000, or almost 8 years, 7.96 years. 4A. Company is planning to purchase a machine that'll cost $24,600, has a 6-year life, and the machine would be depreciated over a 3-year period with no salvage value. The company expects to sell the machine's output of 3,000 units evenly throughout each year. A projected income statement for each year of the asset's life appears below. What is the payback period? Well, we've got to turn this income statement, which has net income, into cash flow. And the way to do that is to take the, net income and add back the depreciation right there, $4,100. And then this gives us cash flow of $7,870, and we'll divide that into the cost of the machine. $7,870 into 24/6 gives us 3.13 years payback. Remember, shorter payback is better. Now let's go on to another method of the accounting profession uses, but they don't use it very much, but it is a method that we're going to be tested on, which is the accounting rate of return. And higher is better. So the accounting rate of return focuses on annual income, not cash flow, and the formula for this is the annual after-tax income divided by the annual average investment. And the annual average investment is a simple calculation, taking the beginning book value plus the ending book value, add them together, divided by 2, and that'll give you the average annual investment. So here's our problem. Company's planning to purchase a machine that'll cost $30,600, have a 6-year life, and be depreciated over a 3-year period with no salvage value. Company expects to sell the machine's output of 3,000 units evenly throughout the year. A projected income statement for each year of the asset's life appears below. What is the accounting rate of return? Well, here's this income statement, and we don't have to turn this into a cash flow because we're not doing a payback period. So we can take net income, which is this $12,500, and divide it by the average investment. So the average investment for this machine, if it cost $30,600, then the formula was the beginning book value plus the ending book value, and that ending means at the end of its life. And so the beginning book value for any asset, it's always its cost. And so the cost is $30,600. Let me say that one more time. The beginning book value for any asset for this calculation is its cost. The ending book value is usually going to be 0 for this calculation, unless the asset has a salvage value. And if it has a salvage value, then that's the ending book value, because you can't depreciate below a salvage value. But anyway, this does not have a salvage value, so the ending book value is 0. The beginning book value is its cost. Add the two together, divide by 2, and take that result and divide it into the $12,000 income, and you get 15.3 divided into 12,500, and the accounting rate of return is 81.70%. Higher is better. Number 6, company buys a machine for $71,000 with an expected life of 5 years, no salvage value. The company anticipates a yearly net income of $3,400 after taxes of 28%, with the cash flows to be received evenly throughout the year. What is the accounting rate of return? Well, it's going to be the income of $3,400 divided by the average book value, which in this case the beginning book value is the cost, $71,000. The ending book value, since this has no salvage value, is going to be 0. Add the two together, divide by 2. That result goes into $3,400, and it's going to be $35,500 divided into $3,400, which is a 9.58% accounting rate of return. Number 7, company uses Monterey Corporation considering the purchase of a machine costing $49,000 with a 9-year life, no salvage value. Monterey uses straight line depreciation and assumes that the annual cash inflow from the machine will be received evenly or uniformly throughout the year. In calculating the rate of return, what is Monterey's average investment? Well, if it's $49,000 for the cost of the machine, you take the beginning book value of $49,000 and the ending book value, since it has no salvage value, of 0. Add the two together, divide by 2, and the book value, the average investment for this situation would be $24,500. Let's go on to the third method for using capital budgeting, which is net present value. Net present value, here's the ruling basically. The net present value of the cash flows minus the amount you invested is equal to the net present value. So, and if the project is more than, if its net present value is more than 0, it's you say yes, it's a go. If its net present value is a negative number, then it's going to be a reject the project. So, what you're looking at really is the present value of the net cash flows. That is what amount of cash discounted back to the present value are you getting in. So cash that you're getting in compared to the cash that you're paying out, that is how much you're investing. And if the cash you're getting in is higher than the cash that's going out, then it's going to be a positive net present value and you're going to accept it. Otherwise, if the amount you invested is more than the net present value of the cash flow they're getting in, that's going to be a negative net present value, and you're going to say we're going to reject it. All right, so let's look at number 8. Daniels Corporation is considering the purchase of a new machine costing $33,000. That is going to be the cash going out the door. The projected annual after-tax income from the equipment is $1,300 after deducting $11,000 depreciation. We don't care about net income. What we care about is cash flow. So we got to convert this to after-tax income into cash flow, and hopefully you know how to do that now. The revenue is to be received at the end of each year. The machine has a useful life of 3 years, no salvage value. Daniels requires 11% return on investments, which this is the discount rate right here, discount rate. That's what we're going to use in our present value tables to discount these cash flows back to time 0. And let's see, the present value of the annuity of 1 for different periods are as follows. Here's the present value of 11% for 1, 2, 3, and 4 periods. And the way we're going to work this is we're going to say, okay, the cash flow for years 1 through 3, which is the life of this machine, will be, looks like the depreciation plus the net income, or it's going to be, looks like $12,300 times a present value table value based on the present value of an annuity, which is going to be, for this case, it's going to be 3 periods at 11%. That is, all these cash flows are going to be discounted back to the present based on 11% for 3 periods, which is 2.4437. Multiply these two amounts together and you get the net present value of these cash flows coming in of $30,058. You compare that to the $33,000 that we spent, and it looks like this is going to be, the net present value is going to be a negative amount, which means you wouldn't want to do this because the net present value is less than 0. Number 9A. The following present value factors are provided for this problem. We've got 4 periods here. We've got the present value of $1, that is a lump sum amount at 12%, and the present value of an annuity, which is a series of equal payments at 12% for 1, 2, 3, and 4 periods. And you got to figure out which one of these you're supposed to use. Norman Company wants to purchase a machine for $60,000. That'll be the cash going out, but needs to earn a 12% return, so that's our discount rate, 12%. The expected year-end net cash flow are $23,000 in each of the first 3 years and $27,000 in the 4th year. So these cash flows are even for the first 3 years, but then you have an uneven, that is not a $23,000 cash inflow for that last year. So what is the machine's net present value to the nearest whole dollar? Okay, we got to discount these cash flows back at 12%, and we'll do it as follows. For years 1 through 3, since they're even cash flows, you can use the present value of an annuity at 12%, and that looks like the table value for 3 periods at 12% is going to be 2.4018, which means the present value of those first 3 years of cash flow will be $55,241. Now the 4th year, since it's not even, we have to do that individually based on the present value of an amount, not a series of equal payments, but one single amount. So we're going to discount that $27,000 based on 12% for 4 periods, that 1 4-year period, going from 4 all the way back to 0, or all back to time 0, which will be a table value of 0.6355. So that means that $27,000 in today's dollars is worth $17,159. The sum of these two will be the sum of all the cash flows, which would be $72,400, and we're going to compare that to the cost of $60,000. And so we're going to get back cash inflows of $72,400. We're going to pay out $60,000. So it looks like our net present value for this is going to be a positive $12,400, which means we should do this. Number 10. A company is considering the purchase of a new piece of equipment for $81,000. The projected after-tax income is $4,200 after deducting $27,000 for depreciation. We're going to combine those two to get a cash flow, right? The machine has a useful life of 3 years, no salvage value. Machine management of the company requires a 10% return on investment, which this is our discount rate. Present value of annuity of 1, various tables. Okay, so let's see here. Our cash flow calculations are going to be as follows. For $31,200, that's going to be the cash flow of the net after tax, adding back the depreciation. So that's going to come up to $31,200, and we're going to multiply that times a present value factor based on 3 periods at 10%, which is present value of annuity, 2.4869. That means these cash flows are worth in today's dollars $77,591. We'll compare that with the initial investment of $81,000, and now you should know that since the payout of cash is higher than the cash coming in, then we're going to have a net present value that's going to be a minus number or a negative number of 3409. Therefore we should not do this.